And welcome to MMT on this historic day in our nation's financial history. One major Wall Street firm goes bankrupt, another Merrill Lynch gets sold in a preemptive move to avoid a similar fate. The biggest insurance company in the world, AIG, is struggling at this hour to stay afloat as the credit and financial crisis gripping the nation takes an ugly turn today. We will tell you what it means for you, your job, and your investments right now on MMT.
From the CN8 studios, this is a special edition of Money Matters Today, Wall Street in Crisis. Now your host, Mary Caracoli.
Good evening to you. It was another working weekend for the Treasury Secretary, the Fed, and all of Wall Street's top bosses. By daybreak, the financial landscape in this country had changed permanently. Lehman is gone, Merrill is no longer independent, and AIG is on the brink. And there is fear that the worst is not over. The implications are great, not just for investors, but for the economy as a whole. We break it down so you understand what this means for your life, your business, and of course our insiders are going to do that for us. Jackie Reeves, Joel Naroff, Tom Meyer, and Patty Brennan all here for you tonight. You can also email us. Go to the Money Matters page at cn8.tv. Well, let's begin with the headlines. The Dow down 500 points in today's session. Lehman Brothers bankrupt, Merrill Lynch sold to Bank of America, and AIG scrambling to secure capital to stay afloat. The credit crisis affects small businesses, big businesses, and your finances. The Dow Jones Industrial Average down more than 500 points, dipping below the lows set in July. The NASDAQ had the best showing of the day of the big three. It had a 3.5% loss, down 58 points. The S&P also dipped below the July lows, seeing its worst percentage drop since the markets reopened after 9/11. This chart tells the story. The market reaction to Lehman and Merrill wasn't good, but it was orderly at the open. But concern about big insurer AIG unraveling and the entire effect of this meltdown on the entire credit crisis and the economy as a whole led to a steep sell-off right at the close. Before the exchanges opened in New York today, European markets sold off. Many Asian markets were closed Monday and right now are getting their first opportunity to trade on the big news. Driving the markets today, a crisis of confidence. Let's start with a story that has everyone concerned at this hour involving the biggest insurance company in the world, AIG. It has $1 trillion of assets on its balance sheet. Right now, it is desperately seeking cash to stay afloat. The Fed says it's not going to do it. It is not going to use taxpayer money, but it is trying to get Goldman Sachs and JP Morgan Chase to lead a group of investors to inject, get this, $75 billion into AIG. $75 billion, Jackie, why does it take such a staggering amount of money to keep AIG afloat?
That's a great question. In fact, I would compound that question with the fact so far today that the New York State had allowed them to have roughly $20 billion in access to capital by really leveraging their own infrastructure. So technically, at the beginning of the trade today, they were in need of roughly $40 billion. So if they already have access to 20, why do they need another extra 70 to 80 billion? And then on top of that, we already have a stressed financial system, as you just noted about Lehman, priorly Bear, in addition to Merrill going to Bank America. So now we're going to ask two very strong financial institutions to take on potentially a questionable credit, which is how we actually came full circle into this current position. So I think that's a good question to ask, and I'm wondering exactly if they are going to step up, how much they're going to step up, and who else is going to be involved in this potential rescue or line of credit, if you will, to AIG if the government is not going to be there.
And I want to simplify this for folks at home because they say, okay, $40 billion to $75 billion. It's too big of a number, Joel, for so many people to even comprehend. But what we're looking at an AIG, once you start getting downgrades, it becomes more expensive to borrow money. All of these things start to unravel slowly, which means it takes more today than it did yesterday to be more solvent.
And that's really the problem. I think what happens is that it's almost a situation where the house collapses upon itself. You know, you have to have some assets backing it. Your asset value goes down, so you have to raise more assets. If you can't raise the assets, then you have to start selling, and ultimately your ability to fund yourself essentially disappears. And that's what's beginning to happen to a lot of financial institutions at this particular point.
And the interesting thing that we're seeing, of course, with AIG is that, Tom, you know, at this hour, there is no confidence out there in the market. So at a time when you're looking to raise cash, as Jackie points out, I mean, does Goldman, does JP Morgan Chase, when there is a crisis at hand, really want to take the risk?
There hasn't been confidence really for the past few months. I mean, let's not forget about Freddie and Fannie on top of everything else. And you look at AIG, here's a perfect example of, hey, you sacrificed Lehman to help and bail out Merrill. Now, could you imagine if Bank of America didn't do the Merrill deal, we would be talking about Merrill today being down about 50%. So now they go right to AIG, and not only is it a crisis of confidence, you got the shorts in there, they're just battering the stock right now. And I got to tell you, I can't believe that the government's going to have to come in here.
All right, well, we're going to get back to this AIG story and the whole unraveling in just a minute, but let's take a look at the other big headline of the day. This would have been a lead had it not been for AIG. Lehman Brothers bankrupt. Its investment management division and other divisions on the market. Lehman has been in the crosshairs of the rumor mongers since Bear Stearns failed in March. But last week, the real unraveling kicked in. Tuesday, speculation began growing that Lehman Brothers might not survive. The stock lost half of its value. Wednesday, in an effort to calm those jitters, Lehman announced its quarterly earnings more than a week early. The news was bad, a $3.9 billion loss, the biggest loss in Lehman's 158-year history. CEO Richard Fuld announced a plan to revive Lehman by selling a majority stake in its investment management business, spin off its commercial real estate assets, and slash its dividend. Wall Street was not impressed. The stock continued to plunge. Thursday, as confidence in Lehman continued to wane, the stock dropped below $4 a share. Fuld moved forward with plans to try to sell the entire company. Among those expressing interest, Barclays and Bank of America. But both wanted the federal government to absorb a portion of Lehman's losses. After all, the government committed about $30 billion for JP Morgan's takeover of Bear Stearns and $200 billion to rescue Fannie Mae and Freddie Mac.
The situation in March and the situation and the facts around Bear Stearns were very, very different to the situation we are looking at here in September.
Friday, the Federal Reserve called together Wall Street's biggest institutions to come up with a solution to the Lehman crisis. According to the New York Times, Treasury Secretary Hank Paulson made it clear that the government would not use taxpayer money to save Lehman, and that an industry solution was needed. The industry disagreed, and Lehman began drafting bankruptcy plans. Saturday, the Fed made a last-ditch effort to get Wall Street firms to rescue Lehman, but even a potential deal with Barclays fell through. While all that was going on, Merrill Lynch dove for cover, holding talks with Bank of America. Merrill had been hit by more than $52 billion in losses and write-downs from the whole subprime mortgage crisis. By Sunday, a deal was struck. Bank of America would pay $29 a share, or about $50 billion, ending 94 years of independence for Merrill.
And the expectation for the difficulties in the marketplace following the Lehman bankruptcy really led us to start to think about what types of transactions might make sense for us.
All right, and as you might expect, it was a lousy day for the financials. Even Merrill Lynch, it managed to have a little pop-up there, but far below that $29 a share asking price. Lehman basically down to zero. Bank of America punished 21%, AIG down 60%, even Goldman down. Look at Washington Mutual now trading at $2 a share. No panic, but Jackie, help put all of this in perspective for us. Why should our viewers care that Lehman Brothers went bankrupt and that AIG is teetering on the edge? Companies go bust every day in this country. Why does this matter?
It matters because I believe at the foundation of everything that's happening right now is a crisis of confidence and credibility with respect to the U.S. financial system. So I think that's really why they should care. I do, and have heard obviously the talks all day today, and I would reinforce that the deposits in the franchises are safe and secure. So we haven't seen any, thankful, run on any types of institutions, and that shouldn't be a fear. But like I said,